You don't blow up because of one bad trade. You blow up because you refuse to take one small, controlled loss. That's the brutal truth most traders learn too late, usually with their account balance as the tuition payment. The irony is savage and precise. The very thing designed to save you becomes the tool you negotiate with until it's worthless. And by the time you realize what you've done, you've taught yourself the most expensive lesson in markets. Hope is not a strategy. Think about your own trading history for a moment. The trades that really hurt you, the ones that left scars on your confidence, were they the positions that lost 1%, 2%, a clean and controlled exit? Or were they the ones you gave a little more room, the ones you refused to cut, the ones that transformed from temporary drawdowns into account-threatening catastrophes? One decision, the decision not to take a planned small loss, is how trading accounts die. In 1901, Jesse Livermore, already a seasoned tape reader who had turned bucket shop games into real money, paid this tuition in full. Northern Pacific Railroad was in play, and every signal on the tape screamed accumulation. He didn't chase. He built his position methodically, pyramiding only after the market confirmed his judgment. $40 became $45, then $50, then $55. Each addition came only after price proved him right. No guessing, no hoping, just responding to what the market was actually doing. Then, the real move exploded. Northern Pacific went parabolic. 50 became 60, 70, 90. At $110, his paper profit was $83,000 in just 3 days. Adjusted for inflation, that's over $2 million in today's purchasing power. Imagine that feeling at 24 years old. You've read the tape like a book. You've outsmarted the crowd. The market is confirming everything you believe about yourself. You start calculating what you'll buy. You start thinking you've solved the puzzle. Then, without warning, the script flipped. Northern Pacific ticked down to 108. Then 103. Back to 98. Livermore watched the tape and told himself the same story every losing trader tells. This is just a shakeout, a normal reaction after such a big move. It'll bounce. I'm in the strongest stock in the market. The fundamentals haven't changed. 95. 92. 87. At each level, his gut started talking louder than his rules. Every tick down made it harder to act rationally. The more he lost of his unrealized profit, the more attached he became to getting it back. Instead of asking, "Where is my stop?" he asked, "Where will it turn?" That one shift, from exit planning to market prediction, cost him $72,000. By the time he finally capitulated and sold, the $83,000 had rotted into $11,000. One stubborn week erased months of discipline. The trade that should have been career-making became a character test that he initially failed. Here's where you need to be brutally honest with yourself. In that same situation, watching a massive winner decay tick by tick, what would you have done? Taken the first sign of serious reversal and preserved the bulk of the move? Or would you have watched, rationalized, and waited for confirmation that never came? This is the identity test that separates survivors from casualties. Amateurs ask, "How much can I make if this keeps going?" Professionals ask, "How much must I not lose if this turns against me?" Same stock, same tape, same price action, but completely different questions leading to completely different outcomes. The amateur dreams in profits. The professional plans in losses. Most retail traders have what they call a stop loss on their platform, and absolutely nothing in their head. They place the order because they know they're supposed to have one, not because they've truly accepted the risk. Then the market moves against them, and the script is always identical. Price creeps toward the stop level. They feel that familiar knot in their stomach. They think, "It's just noise. The market makers are hunting stops. I'll give it a little more room to work." They move the stop a few ticks lower. Then they cancel it just for a second while they watch what happens. But when you cancel a stop loss, you're not giving your position room to breathe. You're handing the steering wheel to fear and hope. That second you cancel the order is the exact moment you choose your identity. Disciplined trader or emotional gambler. Livermore watched this same psychological movie play out in the bucket shops and on Wall Street over and over, with men far wealthier and more experienced than he was. Different ticker symbols, same human nature, The pattern didn't change then, and it hasn't changed now, because fear and greed are timeless. The Northern Pacific loss burned a single iron law into his brain. The market does not care about your thesis, your analysis, your research, or your hope. It doesn't know you exist. It only respects one thing: your exit plan, enforced in real time without negotiation. Without a real exit plan, your intelligence becomes a liability. The smarter you are, the better you become at writing persuasive stories to justify staying in a losing trade. Here's the mathematical reality most traders ignore. Lose 10% of your capital, and you need an 11% gain to recover. Manageable. Lose 50%, and you need a 100% gain just to break even. That's not a drawdown, that's a completely different, far more painful journey. Lose 80%, and you need a 400% gain to get back to where you started. That's not recovery, that's starting over. From that Northern Pacific pain, Livermore built something most traders never develop: a survival system. Not a how to hit home runs every month system, but a how to guarantee I'm still solvent when the next real opportunity appears system. He broke it down into 3 deceptively simple, non-negotiable rules. Rule 1. You decide where you are wrong before you dream about where you might be right. The stop comes first. Profit targets come later. Rule 2. You size your position in dollars of actual risk, not in feelings, confidence levels, or arbitrary percentages. Rule 3. When the market proves you wrong by hitting your price or time limit, you act without negotiation, without editing the rule to protect your feelings. Miss any one of these 3, and the system fails completely. You might get lucky for a while, maybe even for a long while. That's the danger. The market rewards bad behavior until it doesn't. Then one day, that one time you don't honor the stop, the market doesn't bounce back. It gaps against you, it trends against you. And you're trapped, telling yourself you'll turn it into a long-term investment. Master all 3 rules, and you join the elite 2% who survive 20 years in this game. Not because you're smarter or have better indicators, but because you understand that survival is the only edge that compounds over decades. In the next chapter, we'll start with rule number 1, and why most traders actually lose money before they even click buy. Because the biggest mistake isn't what happens after you enter a position. It's what you failed to do before you entered. The preparation you skipped. The question you didn't ask. The level you didn't identify. That one moment of laziness or excitement sets up everything that follows. Livermore's first rule sounds deceptively simple until you try to follow it in real time with real money on the line. Decide where you are wrong before you decide how much you want to make. The sequence matters absolutely. Stop first, profit dreams second. But amateurs do the exact reverse every single day. They dream in profits, calculate position size based on how much they want to win, then improvise the risk afterward to justify the position they already decided they wanted. Here's how that disaster looks in the wild, and be honest, because we have all been this person at some point. You see a stock moving. The price is ticking up fast. Green candles are stacking. You feel that sudden rush of adrenaline, that fear of missing out clawing at your chest. Your hand moves toward the buy button. You think, this is it. I have to get in before it runs without me. So you buy at $50. You click the button. Position filled. You're in. Only after your money is already on the table do you pause, glance to the left of the chart, and think, okay, where should I put my stop? You see a swing low around 46 and another around 44. You don't really know which one matters. You don't want to put the stop too tight because you know it's volatile. But you also don't want to see a big red number if it hits. So you split the difference in your mind and say, I'll just tuck the stop somewhere around 45. That seems safe. That's not a plan. That's hope dressed up with a number. You've just committed the cardinal sin of speculation. You let your entry dictate your risk, instead of letting your risk dictate your entry. You're now gambling, not trading. Professionals operate in a completely different mental universe. Before they even consider clicking buy, they ask one specific, unemotional question. Where does the market prove my idea is wrong? Not where do I want to get out? Not how much can I afford to lose? But where does the price action itself invalidate the reason for taking the trade? Let's make this concrete with a systematic breakdown. A stock has been trading in a clean range between $40 and $50 for 3 weeks. Clear support at 40. Clear resistance at 50. You're watching for a breakout. Price finally pushes through 50 with strong volume and closes at 51. You want in. But before you buy, you ask the invalidation question. Where am I wrong? If this stock drops back into the range and closes under $49, your breakout thesis is dead. The breakout failed. The supposed strength was either a head fake or premature. That's not an opinion about what might happen. That's the market structure telling you the setup didn't hold. 49 becomes your invalidation level. That's your stop zone, and it's non-negotiable because it's based on market structure, not your feelings. Now position sizing comes into play, and this is where mathematics replace emotion completely. Let's say your trading account is $10,000. You've decided, in advance, that you will risk 1% of your capital on any single trade. That's a maximum loss of $100 per position. Not $100 that you hope to avoid losing, but $100 that you have fully accepted as the cost of this information. Here's the calculation that separates disciplined traders from gamblers. Your entry is 51. Your invalidation point is 49. The distance between them is $2 per share. Take your maximum dollar risk of $100 and divide it by your per share risk of $2. 100 divided by 2 equals 50 shares. That's your position size, not 500 shares because you're confident, not 10 shares because you're scared. 50 shares, calculated from the stop distance and your risk tolerance. This is the part that breaks most traders psychologically. They do the math and don't like the answer. 50 shares feels too small. They start fantasizing about what they could make if they used 200 shares, or 500. To make those dreams feel reasonable, they quietly move the stop further away. They think, if I put the stop at 47 instead of 49, I can buy more shares. That is not risk management. That is changing the rules to support your desired outcome. The stop defines the size. The size never redefines the stop. Write that down. Tattoo it on your risk management checklist. This single principle, if honored without exception, prevents 90% of account blowups. Here's the mathematical reality that amateurs ignore until it's too late. If you lose 10% of your capital, you need an 11% gain to get back to break even. Annoying, but manageable. You can recover from that in a few good trades, but if you lose 50% of your capital, you now need a 100% gain just to get back to where you started. That's not a drawdown anymore. That's a completely different psychological and mathematical battle. You have to double your money just to see zero again. Lose 70%, and you need a 233% gain. At that point, you're not managing a trading account. You're trying to resurrect a corpse. Small losses are tuition payments. You pay them. You learn. You move forward. Big losses are eviction notices. They remove you from the game entirely. This is why Livermore obsessed over stop placement before anything else. He understood that one uncontrolled loss could erase months of disciplined gains. In 1906, he spotted what looked like distribution in Union Pacific Railroad. The stock was trading at extended levels around $162. The tape showed heaviness. Every rally meant selling. He decided to short, but he didn't start by imagining how far it might fall. He started by asking where the market would prove his read was wrong. He sold short at $162 and fixed his stop at $165. That was his error budget, 3 points. If price pushed above that level, his read was wrong, or his timing was early. Either way, he was out. His risk was defined before his profit was even considered. He calculated his position size based on that 3-point risk. Then the surprise hit. News of an unexpected dividend sent Union Pacific gapping higher on the open. There was no chance to finesse the exit at 165. It opened around 168. He didn't hesitate. He didn't say, well, my original stop was 165, and now it's already past that, so I might as well wait and see what happens. He covered immediately at 168, booking a 6-point loss instead of his planned 3-point loss. It hurt. He admitted later that it stung his pride. No trader enjoys taking a loss that's double the planned size. But look at what happened next. Union Pacific kept climbing. 172, 180, 194. Only then did it finally roll over and begin a real decline, eventually breaking down toward 121. If he had given it room, the way amateurs love to say, if he had moved his stop up to 175 or removed it altogether because it's already gone past my level, he would have been trapped in a runaway train. The loss would have ballooned. His capital and his mental capital would have taken a devastating hit. And when the real short opportunity finally appeared weeks later, he might not have been there to take it because he would have been broke or gun-shy. By taking the painful 6-point loss immediately, he preserved his capital and his clarity. He lived to fight another day. When Union Pacific finally confirmed the breakdown he had originally anticipated, he was able to re-enter the short from a better position and ride it down for the profit he had initially expected. That single episode illustrates the hidden power of honoring tight stops. It's not just about limiting losses. It's about preserving capital and mental clarity so you can re-engage when the setup actually confirms. The traders who refuse to take the small loss get trapped in bad positions, watching the real move happen without them, unable to participate because they're stuck managing a loser. But knowing where to put the stop and how to size the position is only the first half of the battle. The second half is much harder. It's the psychological warfare that happens when the price actually hits that carefully calculated number. Because it's one thing to plan a stop loss on a calm Sunday evening when the markets are closed. It's a completely different beast to execute that stop on a Tuesday morning when the red candles are flashing and your brain is screaming at you to hold on just a little bit longer. In the next chapter, we'll hit the part that destroys even the most disciplined traders who do everything right up to this point. Exactly what you do when that perfectly placed stop gets triggered. Because that moment, those next 60 seconds after the stop executes, determines whether you're building a career or funding someone else's. Most traders treat the stop loss like a suggestion, a starting point for negotiation with the market. Professionals treat it like a fire alarm screaming in a burning building. When that bell rings, you don't stand there debating whether the fire is real or checking the weather forecast. You don't finish your coffee or analyze the temperature of the smoke. You evacuate immediately, because you understand that hesitation in a crisis can be fatal. The single most dangerous moment in any trader's career is not when they take a loss. It's the moment they hesitate to take it. Picture this scenario because you've lived some version of it, probably multiple times. You buy a stock at $100. You've done the homework this time. You identified the setup, calculated your risk, placed your stop at $95. The plan is solid. The math works. You feel professional. Then the market opens, and reality hits the tape. 98, 97, 96. You watch those red ticks cascade down your screen and feel that familiar tightening in your chest. Your palms get damp. The confidence you felt 10 minutes ago evaporates, replaced by low-grade panic. The price hits $95.10, hovering just above your carefully calculated exit door. This is where identities split. This is where the amateur mind begins its fatal negotiation with reality. You stare at the screen, and the internal committee meeting begins. It's so close to my stop. You whisper to yourself. The RISI looks oversold. It has to bounce here. If I sell now, I'm just selling the bottom. I'll give it 50 more cents. Just to 94.50. If it hits that, then I'll really get out. In that split second, you've changed professions entirely. You're no longer a trader executing a plan. You're a gambler hoping for mercy from the market. You've broken the contract you made with your calm, rational self before the trade began, and the market, sensing weakness like a predator, will often punish you for it. The stock slices through 984.50. Now you think, well, 984 is a round number. Psychological support. It cuts through 984 like tissue paper. You're down 6% instead of 5, then 7, then 8. The pain compounds. The paralysis sets in. You decide to become a long-term investor in a stock you only meant to hold for 3 days. Here's the protocol that separates professionals from the casualty list. The standard you must hold yourself to if you want to survive decades in this business. The moment you place any trade, The stop loss is already accepted emotionally, not intellectually accepted, where you nod and say, yes, I understand risk management. Emotionally accepted, where you have actually visualized the price hitting your stop and rehearsed the feeling of taking that specific loss. Professional traders do this work before they click buy. They sit quietly and imagine watching their stop get hit. They feel that momentary sting of being wrong. They accept that money as already spent, the ante required to see the market's cards. It becomes the cost of doing business, no different than a restaurant owner buying ingredients that might spoil or a landlord paying property taxes. When you truly accept the loss before you enter, something magical happens. When the stop actually gets hit, you execute without internal debate. There's no secondary analysis, no checking if the volume looks suspicious, no refreshing the news feed to see if something just broke, no saying let me watch what it does for 5 more minutes. The condition for staying in the trade has been violated, so the trade is over. You click sell. You take the predetermined hit. And then something remarkable happens. The anxiety vanishes instantly. The knot in your stomach unties. You're back in cash, back in control. Your mind clears because you're no longer fighting the tape. You've honored your word to yourself, and now you're ready for the next opportunity. This is the part that breaks most traders psychologically, so listen carefully. Jesse Livermore discovered something counterintuitive that changes how you view every stopped-out trade. Sometimes getting stopped out is exactly what you want to happen. This sounds insane to amateurs who view every loss as personal failure, but Livermore understood that the stop loss was providing valuable information for a small fee. Why celebrate a loss? Because the stop did its job. It told you the truth about market conditions. Your timing was off, or your read was premature, or the market simply wasn't ready to move in your direction yet. By taking that small, controlled loss, you've purchased clarity. You're still alive. Your capital is largely intact. You can take the next high-probability setup without baggage. The amateur sees a stop loss as punishment. The professional sees it as protection. In 1907, Livermore was convinced the market was heading into a major crash. He shorted aggressively, position after position. The market dipped initially, then rallied hard against him. He got stopped out repeatedly over several weeks, taking loss after loss. Each time hurt. Each time felt like the market was mocking his analysis. But each time, he honored his stops and preserved capital. When the real panic finally exploded in October 1907, he was still there with fresh capital and clear thinking to short into the genuine collapse. The traders who had refused to take their stops earlier were already wiped out or too psychologically damaged to act when the real opportunity arrived. But there's a second dimension to stop discipline that most traders completely miss, and it's just as deadly as ignoring price stops. It's called the time stop, and it addresses a silent killer in every portfolio: dead money. Picture this. You buy a breakout expecting immediate momentum. 3 days later, the stock is chopping sideways in a tight range, doing absolutely nothing. Your price stop at 95 hasn't been hit. The stock might be sitting at 99, technically fine. But the trade has failed completely. The logic that justified your entry was momentum and breakout confirmation. If the stock isn't delivering that momentum within a reasonable time frame, your thesis is wrong. Not the price thesis, but the timing thesis. You're no longer trading a setup. You're hoping a stock remembers what it was supposed to do. That's not a position. That's a prayer. Livermore was ruthless about this principle. He said, "Experience has proved to me that the real money made in speculating has been in commitments showing a profit, right from the start. Right from the start. The best trades, the ones that build fortunes, rarely grind against you for weeks before working. They tend to step out immediately, confirm your judgment, and run. If you enter a position and the market doesn't validate your read quickly, it's sending you a warning signal about timing or conditions. Every day that capital sits trapped in a stagnant trade is a day it cannot be deployed into something actually moving. This is opportunity cost, and it represents a real tangible loss even though it doesn't appear in red on your screen. While you're babysitting a zombie position, waiting for it to do something, new leaders in different sectors are breaking out and running 20%. You miss those moves because your capital and your mental bandwidth are tied up in dead weight. Think of your portfolio like a garden. Professional traders are ruthless gardeners. They pull weeds to make room for flowers. They don't water weeds hoping they'll transform into roses. If a position isn't performing its intended function within a reasonable window, they cut it and redeploy that capital into something with actual momentum. This isn't impatience. This is opportunity management. The mathematics of survival demand this discipline. You can take 10 small losses in a row, lose 10% of your account, and recover it all with 1 or 2 solid winners. But one catastrophic loss, one trade where you negotiated with the fire alarm and stayed in the burning building, can end your career. A small loss is tuition you pay to stay in the game and learn the lesson. A big loss is eviction. It kicks you out of the market, destroys your confidence, and forces you to either deposit fresh money or quit entirely. Every time you honor a stop, you cast a vote for your professional identity. You teach your brain, I am the kind of trader who does what they said they would do. That consistency builds unshakable self-trust, and that trust is what allows you to size positions intelligently when genuine A-plus setups appear. Every time you move a stop, ignore a stop, or delay a time stop, you vote for the opposite identity. You teach your brain that your rules are flexible when you don't like the outcome. That erodes confidence and makes future decisions increasingly emotional and reactive. The market will always test your discipline at the worst possible psychological moment. It will push price to within pennies of your stop, tempt you to adjust, then either reverse beautifully to make you feel foolish or continue straight through to validate your original plan. Your job isn't to predict which outcome will happen on any particular trade. Your job is to follow the protocol that keeps you solvent over the next 1,000 trades. Here's your implementation protocol. First, before you enter any position, sit quietly and visualize taking the full stop loss. Feel that sting. Accept it as the cost of information. Second, when the stop hits, execute immediately without debate. Third, implement time stops ruthlessly. If a position doesn't confirm within 3 to 5 days, exit and redeploy the capital. Fourth, never re-enter a stock that just stopped you out for 48 hours minimum. Your judgment was off, and you need time to reset. The fire alarm exists for one reason: to get you out before the damage becomes catastrophic. When it rings, you don't negotiate with the fire. You evacuate. Your stop loss serves the same function. Honor it, and you'll survive to trade another day. Ignore it, and the market will teach you why discipline exists through the most expensive education available. We've now covered defense, how to survive when you're wrong or early. But you don't trade just to survive. You trade to build wealth. In the next chapter, we flip the script entirely. We'll explore how to use stops, not just to limit risk, but to lock in gains when you're winning. Because the traders who master cutting losses quickly, but fail to hold winners long enough, never build real wealth. They survive, but they don't thrive. The next rule transforms survival into success. There is a very specific kind of psychological torture that only traders know, and it has nothing to do with losing money on a bad trade. It's the slow, sick feeling of watching a big winner decay, tick by tick, until it transforms into a loss. You bought at $50. The stock moved immediately in your favor. 52, 54, 57. You were up $1,000 in 3 days. You felt that warm rush of validation, that quiet confirmation that you actually know what you're doing in this game. You started calculating what that profit meant for your month, maybe even told someone about the trade. Then the pullback started. At first, you told yourself the story every drifting trader knows by heart. It's just a correction. Healthy consolidation. All strong trends do this. You watched your open profit shrink from 1,000 to 700 to 500, still manageable, you thought. You're being mature. You're not one of those amateurs who panics on every little dip and cuts winners too early. But the stock kept sliding. 53, 52, 51. Now you're back at your entry price, staring at a flat position. For the first time since the trade started working, you're back at zero. That's when the real psychological damage begins. This is just a retest, you tell yourself. It will bounce here. This is strong support. But it doesn't bounce. It slices straight through 50 and keeps falling. 49, 48, 47. Now you're not just giving back gains. You're actually losing money on a trade that was once solidly profitable. This creates a special kind of paralysis. You don't want to lock in the loss because that feels unbearable after seeing the position so green. You don't want to watch it slide further, but you also can't accept that you've mismanaged a winner. So you sit there, frozen, watching the red number grow, promising yourself you'll sell if it just gets back to break even. You've just experienced the emotional wreckage that destroys more trading careers than any single bad trade ever could. You've violated rule number 3, never let a winner become a loser. Once a position moves significantly in your favor, you must move your stop to break even or better. You must systematically remove the risk of loss entirely. This isn't about being conservative or scared. This is about protecting the most valuable asset you possess as a trader: your confidence. Here's the identity test that separates survivors from casualties in this specific situation. The amateur looks at a position up 3 points and says, "I need to give it room to work. If I move my stop up, I might get shaken out of a big winner." The professional looks at that same position and says, "I've earned the right to a risk-free trade. The market has confirmed my judgment. Now I protect that confirmation." Same chart, same price action, completely different mental framework, radically different outcomes over decades. Jesse Livermore understood something that most traders never grasp until it's too late. Your confidence is more valuable than any individual trade. Your capital is vital, but your belief in your own discipline is what allows that capital to compound. Nothing erodes that belief faster than watching a solid winner rot into a loss. That experience doesn't just hurt your account balance. It stains your decision-making process. On the next A-plus setup, you hesitate. You second-guess whether you should take profits early. You don't trust your own plan because you've already watched yourself betray it. This is the invisible damage that round-trip trades inflict. They teach your subconscious mind a devastating lesson. Even when I'm right, I still lose. That lesson creates hesitation on future setups. It makes you trade smaller when you should be trading larger. It makes you exit winners too early because you're afraid the market will take them back. You've contaminated your process with doubt, and doubt is the enemy of consistent profitability. The protocol is mathematically simple, but emotionally challenging. Once your position shows a profit equal to your original risk, you immediately move your stop to break even. Not to think about it. Not to wait and see if momentum continues. Immediately. Let's make this concrete, so there's zero ambiguity about execution. You buy at $50. Your initial stop, based on market structure, is at $47. That's 3 points of risk per share. You've accepted this 3-point loss as the cost of information before you entered. The stock runs in your favor to 53. You're now up 3 points, exactly equal to your original risk. At that precise moment, you cancel your stop at 47 and replace it with a stop at 50. Your entry price becomes your new exit level if the trade reverses. You're now playing with the house's money. The mathematical worst-case scenario has shifted from a 3-point loss to a scratch trade. The best case remains unlimited upside. This single adjustment transforms your psychological relationship with the position completely. Before, you had real capital at risk and were fighting to avoid pain. Now, you're managing a position that cannot hurt you financially. The anxiety evaporates. You can think clearly. You can let the trade develop without that knot in your stomach, because you've already won by not losing. But here's where most traders sabotage themselves even after executing the break-even rule perfectly. The stock pulls back and stops them out at 50. They watch it for the next hour, and it starts climbing again. "I knew it," they think. "I got shaken out." The setup is even better now because the weak hands are gone. They re-enter, often at a worse price than their original entry. Then the stock reverses again and stops them out a second time. Now they're not at break-even anymore. They've taken 2 small losses on the same name in the same session, and their confidence is fractured. This is where Rule 3 has a second, equally critical component. Never re-enter a stock that just stopped you out for a minimum of 48 hours. No exceptions. No rationalizations. No, but the volume pattern is confirming now. The stock that just removed you from the game is radioactive to you for 2 full trading days. This isn't arbitrary punishment. This is psychological armor against revenge trading. When you get stopped out of any position, even at break-even, your ego takes a small hit. You feel like the market tricked you or shook you out unfairly. That feeling creates a dangerous compulsion, the need to prove you were right, to get back in and show the market it made a mistake. That desire has nothing to do with probability or edge. That's pure ego seeking validation, and ego-driven trades are how accounts die. In 1908, Livermore was analyzing Reading Railroad with intense focus. The tape showed distribution patterns. Volume was heavy on down days, light on rallies. He shorted at $984 with a tight stop at $986, accepting just 2 points of risk. Within 2 hours of entry, Reading ticked up and triggered his stop. He covered immediately at 96, taking his planned loss without debate or negotiation. Here's where the real test came. By the close of that same trading session, Reading had reversed and dropped back to $93, a full point below his original short entry. Every instinct in his body screamed to re-enter the position. The setup looked perfect. His original analysis appeared validated. The stock was showing exactly the weakness he had anticipated when he first pulled the trigger. But Livermore had learned this lesson through previous pain. He had a rule specifically designed for moments like this, when emotion runs hot and rationalization feels most convincing. He forced himself to stay out. He watched from the sidelines, doing absolutely nothing, while his brain generated a dozen reasons why re-entering was the smart play. Over the next 3 trading days, Reading didn't collapse as expected. Instead, it rallied aggressively, pushing through 98, then 100, then 102. If Livermore had broken his own 48-hour lockout rule and reshorted at 93, convinced his timing had just been slightly early, he would have been stopped out a second time around 96 or 97. If he had moved his stop to give it more room, he might have been stopped at 99 or higher. If he had removed the stop entirely in frustration, he would have been trapped in a position moving violently against him. By the time Reading finally peaked and began its real decline weeks later, a trader who kept fighting the same stock would have been stopped out multiple times, psychologically destroyed, and likely out of capital to participate in the eventual profitable move. The 48-hour lockout rule saved him from this death spiral by forcing him to move on to fresh opportunities in different names. This rule accomplishes something subtle, but powerful for your long-term psychology. It teaches you that individual trades are meaningless. What matters is the system, the process, the discipline of following your rules across hundreds of positions. When you can walk away from a stock that just hurt you and immediately start scanning for setups in completely different sectors, you've achieved the emotional detachment that separates professionals from gamblers. Here's the compound effect most traders never consider. Every time you move a stop to break even and get taken out, you've just had a neutral experience. You didn't make money, but you didn't lose money either. Your confidence remains intact. Your capital remains intact. You're ready for the next opportunity with a clear head. Compare that to repeatedly letting winners become losers. Each round trip inflicts both financial damage and psychological damage. Your confidence erodes incrementally. You start sizing positions smaller. You start hesitating on obvious setups. Eventually, you stop trading altogether because you can't trust your own execution. The professional builds a fortress around winning positions. They use break-even stops as the first layer of defense against round trips. They trail stops under rising support levels as positions extend. They add to winners only when risk per share shrinks. They never, ever allow a position that was once profitable to turn red. This isn't about optimizing every single trade in isolation. This is about protecting progress over thousands of trades. Your implementation protocol is non-negotiable. First, once profit equals original risk, move the stop to break even immediately. Don't wait for confirmation. Don't check if volume is supporting the move. Move it. Second, if you get stopped out at break even, celebrate the fact that you just took zero heat on a position that could have hurt you. Third, honor the 48-hour lockout religiously. The stock that just stopped you out is dead to you for 2 full sessions. Fourth, use that forced break to scan for fresh setups in different names, different sectors, different themes entirely. The maxim you need to internalize until it becomes reflexive: never let a profit turn into a loss. Better to be stopped out at break even and watch the stock moon without you than to ride it all the way to the basement. This will sometimes be painful. You will get stopped out at 50 and watch the stock run to 60. That will sting. But that sting is nothing compared to the psychological devastation of watching a 5-point winner become a 3-point loser. When you protect winners with break-even stops and honor lockout periods religiously, you build unshakable self-trust. You prove to your subconscious mind that when you're right, you get paid. That belief is what allows you to take the next trade with full conviction. It's what allows you to size positions appropriately when genuine A-plus setups appear. It's what keeps you in the game for decades while 98% of participants wash out. We've now covered all 3 survival rules in detail. Where to place stops before entry. How to execute them without negotiation when hit. How to protect winners once they develop. But knowing these rules intellectually and implementing them under real-time pressure are completely different challenges. In our final chapter, we'll integrate all 3 components into a complete operating system that runs on autopilot, a daily protocol so clear and mechanical that it removes emotion from the equation entirely. Because the goal isn't just to understand these principles. The goal is to make them reflexive, to build a system that protects you even when you're tired, distracted, or emotionally compromised. Jesse Livermore didn't survive 4 decades in the most brutal financial arena on earth because he could predict the future. He survived because he always knew his exit before he knew his entry. That single distinction, that complete reversal of priority, separated him from the countless speculators who came and went like summer thunderstorms. The difference between amateur and professional isn't intelligence, education, or access to information. It's the understanding that survival is the only edge that compounds over decades. Up to now, we've dissected 3 rules in isolation. Where to place stops before entry. How to execute them without negotiation. How to protect winners from becoming losers. But knowledge alone doesn't save your capital when the market is moving fast and your money is evaporating in real time. Reflex does. The real game is turning those rules into an operating system so automatic that you follow them even on your worst days, when you're tired, stressed, or overconfident. Let's start by contrasting the 2 loops that define trading careers, the amateur death spiral versus the professional survival cycle. The amateur death spiral. The amateur pattern is so predictable, it's almost tragic. You see a setup that looks compelling. Maybe it's a breakout, a reversal, some chart pattern that triggers recognition. But instead of asking, where am I wrong? Your first thought jumps straight to profit fantasies. You calculate how much you could make if it runs 10 points, 20 points. You start imagining what that money could buy, how it would feel to be right on such an obvious winner. That fantasy directly determines your position size. You buy more shares than your system allows because this opportunity feels too good to trade small. Only after your money is committed do you glance at the chart and improvise a stop somewhere that feels safe but isn't based on any actual market structure. The trade moves against you. Because the position is oversized, the fear hits immediately. You freeze. You switch from trading to hoping. The loss deepens beyond what you plan to risk. Your account takes real damage. Then, because you need to make the money back quickly, you repeat the entire cycle with even less discipline. This loop continues until the account is gone, or you quit trading entirely, convinced the market is rigged against retail participants. The professional survival cycle. The professional cycle looks completely different. It's colder, calmer, and infinitely more boring to observe, which is exactly why it works over decades. Professionals don't trade for excitement or validation. They trade for survival first, profit second. Their system removes discretion at every decision point where emotion typically hijacks judgment. There's no fantasy phase. There's no ego involvement. There's only process, executed with mechanical precision. Here's the 5-step daily protocol that transforms these 3 rules from intellectual concepts into reflexive behavior. Step 1. Setup and size through invalidation. Before you even consider clicking buy, you open the chart and mark the exact price level where your thesis becomes invalid, not where you'd prefer to exit if things go poorly, not where it would be convenient for your desired position size. The specific level where the market structure itself tells you that your read was wrong or your timing was off. This might be below a key support zone, above a resistance level you expected to hold, or outside a range you anticipated containing price action. Once you identify that invalidation point, you calculate the distance from your intended entry to that stop level. Then you take your maximum risk per trade, typically 0.5% to 1% of your total equity, and divide it by the per share risk. That mathematical calculation gives you your position size, not your confidence level about the setup, not your conviction about the direction. Pure mathematics derived from your stop distance and risk tolerance. You don't adjust the stop to fit a desired position size. You accept whatever position size the stop distance allows, even if it feels uncomfortably small. Step 2. Pre-commitment protocol. This step addresses the most dangerous moment in any trade, when your stop is about to be hit and your brain starts generating reasons why the rule doesn't apply this time. You need to pre-commit to obedience before the trade goes live. This isn't a mental note or intellectual agreement. Say it out loud, actually vocalize these words. If this stop hits, I am out immediately. No questions. No second guessing. No waiting to see what happens next. You're placing a binding contract on your future self, the version of you who will be emotionally compromised when the stop triggers. That future you will want to negotiate, to find reasons why the stop doesn't really count, to give the position just a little more room. By verbalizing the commitment now, while you're calm and rational, you create a psychological anchor that makes it much harder to break your own rule when pressure arrives. You're binding yourself to the mast so you cannot steer the ship into the rocks when the sirens start singing. This step addresses the emotional aftermath of getting stopped out, which is where most traders spiral into revenge trading or analysis paralysis. You must fundamentally reframe what a triggered stop means. The amateur feels pain, rejection, and personal failure when a stop hits. The professional feels relief and clarity. When a stop triggers, your internal dialogue should be, good. Now I know something valuable. My timing was off, or that support level was weaker than I assessed, or my read on momentum was premature. You paid a small, predetermined fee to get crucial information about current market conditions. You're now in cash, and cash is not a neutral position. Cash is a position of power. You're not trapped in a losing trade. You're not hoping for a reversal. You have complete flexibility to deploy capital into the next genuine opportunity that appears. You're the predator waiting in tall grass, not the prey running for survival. Once a trade moves in your favor, and you've implemented the break-even rule from Chapter 4, you shift from defense to offense, but you do it without emotional interference. You trail your winners based on objective market structure, not on your anxiety about giving back profit. You don't choke the trade with over-tight stops because you're scared of losing a few dollars. Wait for the stock to establish a new higher low in an uptrend, then move your stop underneath that structural level. You're locking in the new reality that the market has created. Consider adding to winning positions only when two conditions are met simultaneously. The risk per share has decreased because price has moved in your favor, and the price action is confirming continuation with volume and momentum. Never add to losers. Never average down. Only pyramid into strength when you can do so while actually reducing your overall risk per share. This final step protects you from the most insidious enemy in trading, the compulsion to immediately re-engage with a stock that just hurt you. You must honor the 48-hour lockout period with religious discipline. The stock that just stopped you out is radioactive to you for 2 full trading days minimum. No exceptions, even if it sets up again perfectly. Even if it looks like the real move is starting now. Even if you're convinced you were just early by 1 day. Your judgment about that specific name is compromised. Your ego wants validation. Your brain wants to prove it was right all along. Walk away. There are 3,000 stocks in the market. If you cannot stay away from the one that just removed you for 48 hours, you're not trading based on probability and edge. You're seeking emotional closure, and that's how accounts die. By forcing yourself to look elsewhere, you break the emotional fixation and force your brain to reset. In October 1929, the market crashed in the most devastating financial collapse in American history. Fortunes that had been built over decades were erased in days. Men who owned railroads and steel mills were wiped out completely. Amidst that carnage, Jesse Livermore shorted the crash with perfect timing and precision. He turned his stake into $100 million, equivalent to over $1.5 billion in today's purchasing power. That single sequence of trades cemented his legend forever. But here's the critical insight that most people miss when they hear that astronomical number. Livermore didn't make that fortune because he was smarter than everyone else in 1929. He didn't make it because he had a secret formula or inside information. He made it because he was still in the game after 28 years of trading, while thousands of other speculators had already blown up and disappeared from the scene entirely. Think about that timeline carefully. 28 years of surviving bull markets, bear markets, panics, manias, world wars, and countless personal mistakes. He had blown up multiple times earlier in his career and rebuilt from scratch. He had violated his own rules and paid severe prices. But the crucial difference is that he survived long enough, with enough capital and psychological clarity intact, to recognize and capitalize on the opportunity when it finally arrived. The traders who were smarter, better educated, and better connected than Livermore in 1901 were long gone by 1929. They had been eliminated by one catastrophic loss, one failure to honor a stop, one revenge trade that spiraled out of control. They were watching from the sidelines, broke and bitter, while Livermore operated with the calm precision of a surgeon. This reframes everything about how you should view your trading career. Your edge in this market is not your technical analysis system. It's not your ability to read earnings reports or economic data. Your edge is that you will still be trading in 5 years when 98% of the people who started with you have quit or gone broke. Your edge is survival in a game of attrition. The market is designed to eliminate participants. The last trader standing wins the ultimate prize. Every time you honor a stop, you cast a vote for your professional identity. You teach your brain, I am the kind of trader who does what they said they would do. That consistency builds unshakable self-trust. Every time you move a stop, ignore a stop, or delay a time stop, you vote for the opposite identity. You teach your brain that your rules are flexible when you don't like the outcome. That erodes confidence and makes future decisions increasingly emotional and reactive. Here's your 4-part mantra to tattoo on your process and repeat before every trading session. Cut losses fast. Size small. Trail smart. Wait often. Those 12 words contain the entire philosophy of professional speculation. Cut losses fast means honoring stops the moment they trigger, with no negotiation or delay. Size small means accepting position sizes that feel uncomfortably tiny relative to your conviction, because small size is what allows you to survive being wrong repeatedly. Trail smart means adjusting stops based on objective price structure, not fear or greed. Wait often means recognizing that doing nothing is frequently the highest ROI position you can take, that patience between setups is as important as execution during setups. This is Livermore's complete survival system, distilled from 4 decades of wins, losses, bankruptcies, and comebacks. 3 rules expressed through a 5-step daily protocol, enforced with zero flexibility for total survival. The rules work because they remove your discretion at the exact moments when your judgment is most compromised by emotion. You don't decide whether to honor a stop based on how you feel about the trade. You honor it because that's the system. You don't decide whether to re-enter a stock based on whether the setup looks better now. You stay out for 48 hours, because that's the system. You don't decide position size based on conviction or confidence. You calculate it from stop distance and risk tolerance, because that's the system. The system doesn't guarantee you'll be profitable on any individual trade, or even any individual month. What it guarantees is that you won't be eliminated. And in a game where 98% of participants eventually get eliminated, not being eliminated is the ultimate competitive advantage. It means you're still there when the genuine A-plus setups appear. You're still there when market conditions shift dramatically in your favor. You're still there when the next 1929, the next historic opportunity, presents itself. When you fall to the level of your training, rather than rise to the level of your expectations, this system catches you. When fear and greed are screaming in your ears, this protocol operates automatically. When you're tired, distracted, or overconfident, these rules protect you from the worst version of yourself. If this framework resonates with you, if you recognize yourself in the amateur patterns we've described and want to build the professional patterns instead, The next lesson you need is on patience. We need to explore how doing absolutely nothing can be your highest ROI position. How waiting for A-plus setups instead of trading every B and C setup transforms your results completely. How the discipline to not trade often matters more than the discipline to trade well. Because when ironclad stop-loss discipline meets the superpower of genuine patience, you stop gambling on every market wiggle and start operating like a true professional. You stop trying to make money every single day and start positioning yourself to make serious money when conditions are actually favorable. That's when trading transforms from a stress-filled gamble into a systematic process that compounds wealth over decades.